Hi friends, welcome to our next video. So in this video I'll be explaining section 1.4. 1.4 is actually easy only, um, like all those three chapters which we learned before. So this chapter deals with accounting cycle, analysis of transaction, etc. And first thing here we are going to see is stages of accounting cycle. Okay, so this actually explains about the order of how to record a transaction and how to present it in financial statements. What are the procedures? Okay, so the first thing we have to do is to identify the transaction. First step in the accounting cycle is to analyze events to determine if they are transactions, and transactions are the starting point from which the rest of the accounting cycle will follow. First thing is to, as you all know, it is to identify the transaction. First thing we have to understand is we have to understand whether it is a transaction or not, and the second point deals with that says that recording transaction in books of original entry. So here it actually refers to journal entries. So after identifying the transaction, next thing we have to do is to pass the journal entry. Okay, so here is where we will pass journal entry, and then what will we do? We'll post it to the ledger, right? With the help of the journal entries, we'll be posting it to the ledger. Then what happens? After taking all the ledger account closing balances, we will prepare ledgers, right? And in each ledger, we will be having closing balances. These closing balances will be taken into a trial balance. Okay, so the trial balance is prepared at the end of the period for the preparations of financial statements. Then what happens? All the adjustment entries are to be recorded properly and adjusted accordingly before preparing financial statements. Adjustments like prepaid expenses, accruals, and all used to adjust it, right? So these adjustment entries have to be recorded properly and have to be adjusted accordingly so that we could prepare financial statements. Then is an adjusted trial balance also may also be prepared. Then comes what? We have to close the entries. We have to close the books. All the nominal accounts are to be closed by the transferring to trading account and profit and loss account. So what we have to do? All the nominal accounts have to be closed. How? We are after by transferring it into a trading account or trading account and profit and loss account. Okay. Then next step is financial statements. We have to draft the financial statements. Now we can easily prepare. After doing all the steps, we can easily prepare financial statements which will exhibit the true financial position and operating results. So this is simple. This is accounting cycle. This is all about accounting cycle. In our study mat, it actually explains 8 steps. First step is to identify the transactions. First thing we have to do is, very basic thing is to understand whether it is a transaction or not. Then next thing is we have to pass journal entries, and with these journal entries, the third step, we have to prepare ledger, and then the closing balances in the ledger have to be transferred to trial balance, and we have to also adjust these adjustments accordingly. After that, we may prepare a adjusted trial balance, and after that we have to close the entries. How do we close the entries? We have to transfer it into the trading and profit and loss account. And what happens? We after that we'll prepare the financial statements, right? Financial statements can be easily be prepared. So that's all about the accounting cycle, and they are showing us it in a diagram kind of format, so you'll be able to learn it fast. Okay, at least learn this keywords, like keywords in the sense of bold letters. At least you have to know that. You'll be knowing that, of course, as we have already learned it in our foundation or cat classes. Okay, then next is events and transactions. And next topic is events and transactions. It is a simple topic only. If you ask me what is an event, why are we discussing event here is because in order to define transaction, we have to first understand what is an event. So event means everything that happens in our human life. That is what our study might say. Like, I'm teaching you now, I'm teaching a class, I'm teaching you classes. So that is an event. You are listening to the class, that is an event. And everything that happens, everything is an event. Like, say I'm eating my food, that is an event. So everything is an event. But when it comes to transactions, is every event transactions? No. Transactions are events only, but not every events are transactions, because if you want an event to be a transaction, then it shall actually involve exchange of values. Exchange of values means there should be something of monetary element inside it. That is what and transaction that is what we call as a transaction. There should be a monetary impact, as it said in our study mat. There should be some kind of exchange of values to happen so that an event can be a transaction. So to put simply, event, every not every every transaction is an event, but not every event is a transaction. Okay, so that is it. And in order to be considered as a transaction, an event has to satisfy the following conditions. So we are actually talking about four conditions for an event to be called as a transaction. Let's see what are they. It must be measurable in terms of money, as I've already told you. It should have a kind of monetary value or exchange of values. So it should be measurable in terms of money. Okay, then comes, it should involve at least two parties. Okay, transaction can only happen if there is two parties, of course. Then it involves a monetary exchange for a goods or service. So we are not just simply giving money to someone. There should be some kind of exchange of goods also. Okay, a goods or service as well. That is the third point, saying it must cause a change in the financial position of the entity. Okay, that means this transaction should have some kind of impact on the financial position of the entity. That's it. Okay, so these are the conditions for an event to be called as a transaction. That's it. There is nothing much to, there is no need to give too much stress on it, but still it is good if you understand that. If you are able to write it in your own words, that is way more better. Then comes analysis of transactions. Yeah, there you go. In the following example of a trading proprietorship business, various illustrative transactions are used to understand the changes in different elements of accounting. Okay, so they are actually talking about changes that is happening. Let's say the first transaction. What happens? Mr. Suman, they commences his business by investing rupees 5 lakh in cash. So Mr. Suman, he's beginning a business. So he's starting a business by investing 5 lakh in cash, right? So what kind of changes does that bring into a transaction? Cash increases, right? Into the business he's bringing 5 lakh. So cash increases in the business, that is 5 lakh is increasing, asset is increasing, capital also increasing. We know how we are going to pass a journal entry, right? How do we pass a journal entry? Because cash is an asset, asset is increasing, if asset is going to increase, what we have to do? We have to debit. And capital is also increasing, what we have to do? We have to credit, right? So the journal entry will be cash account debit to capital account, amount will be 5 lakh. That is exactly what they are telling, but it is not in the form of journal entry. That's all. So cash is increasing, asset is increasing, so 5 lakh in the business is increasing. Then capital is also increasing because he's bringing the capital in the form of cash only. That's it. Second transaction is Mr. Suman opened a current account with the bank by depositing 2 lakh. So he's opening a current account and he's depositing 2 lakh in it. So what changes, or what changes does it bring into the transaction? Cash balance, what happens? He's depositing 2 lakh into a current account. Okay, so asset is decreasing. He's depositing, like means he's depositing 2 lakh into the bank, means the asset cash is decreasing, right? You have to take the money, and in bank the cash increases. We are taking money from our cash, so cash decreases from our business, but he is also depositing the same money into the bank of that business. So that means bank is also an asset, so asset increases and asset decreases as well. So that is what explaining here. The transaction 3, he's borrowing rupees 1,20,000 from bank, and its interest is 10% per annum. Okay, so what happens? He's borrowing money from bank. That means money is increasing, cash is increasing, 1,20,000 is increasing. That means bank balance is increasing, so asset is increasing. Fine, as he's borrowing money, and what happens? Loan is also increasing. He has got a liability, right? Loan is a liability, so you have to pay it back. So that means loan is increasing. That is a liability. So liability is also increasing. We have to credit the liability. And transaction 4 explains that Mr. Suman purchases an equipment which is of rupees 80,000, and that is for cash, completely in cash. So what happens? Asset, equipment is an asset. So when asset is increasing, we have to debit. So equipment increased by rupees 80,000, and cash is decreasing because he's paying cash only. He's not buying it for credit, so he's paying cash correctly. So that means our cash decreases, 80,000 decreases. Transaction 5. He purchased goods worth rupees 1 lakh for resale, out of which 60% was paid in cash, 30% by check, and balance was due. What is happening here? Here, he's buying his goods so that he could sale, right? This is the goods means something that we are buying so that we can sell it to the customers. That is our business. So he has purchased goods for 1 lakh he has purchased, and that is for resale. And out of this 1 lakh, 60% means 60,000 rupees is paid in cash, 30,000 rupees is paid by check, and the balance amount means 10,000 rupees he have to pay again. He has not paid that 10,000 rupees yet. He have to pay that 10,000 rupees. Okay. So what is happening here? He is purchasing, right? He's purchasing for 1 lakh. Purchase is an expense. So expense, when expense is increasing, we have to debit it. Then cash balance decreases to 60,000. Why? Because he's paying 60,000 rupees. Bank balance decreases by 30,000 because he is giving check of rupees 30,000. So the amount which is there in the bank will decrease. And balance was due, right? He have to pay. Now he have got a liability to pay rupees 10,000 as well. He have to pay that. That is a payable. So that is liability. So it is increasing. So we have to credit that 10,000 rupees. Liability increases. Transaction 6 talks about he is selling goods for cash 1,70,000. So sales is actually a revenue, and sales is increasing, right? So we have to credit it. And also cash. Cash means asset only. So that is also increasing. So we have to debit it. Then transaction number 7 talks about goods sold on credit for 80,000. Yes, he is selling goods for credit. That means he is not receiving any money. So what is happening here? He's got debtors, right? Debtors means those people who are owing money to us. So the debtors is increasing. Debtors is an asset. So debtors is increasing 80,000, and he has sold it, right? So that is sales only. So revenue is also increasing. We have to recognize it likewise. And transaction 8. Mr. Suman incurred rupees 20,000 as wages. So 20,000 wages is an expense. When expense increases, we have to debit. And we are paying wages, right? When we are paying wages, in what form do we pay? Cash, of course. So cash is decreasing, asset is decreasing. Transaction 9. Interest on bank loan charged rupees 3,000. Bank loan, and that was rupees 3,000. So the bank loan interest is an expense, right? Bank loan interest is an expense. Increased. Bank balance decreased by 3,000. Yes. So expense. Since we are to assume that when bank loan interest all are paying, we will assume that we are taking it from our bank account, not in cash flow. But at times they have also mentioned that but most of the time we'll assume that we're taking that bank interest amount from our bank account. So thus we'll be showing in our journal entries, and all will be showing our bank account only. Our bank account decreases as this 3,000 is being taken from our bank account. It is like it is in that way we assume. So expense increases as well. Bank interest is an expense, so we have to debit it. And what happens? Our bank balance decreases because this 3,000 is being taken from our bank account only. Okay, so there is we are assuming like that we'll take it from our bank account only. So 3,000 is decreasing, bank is decreasing. That means bank is an asset, so asset is decreasing. That's it. The transaction number 10, he's collecting cash of rupees 20,000 from his customer. So cash is increasing, right? Cash is an asset, so we'll debit it 20,000. And what happens? Debtors decreases, means the people who are owing money to us is decreasing as he's paying us, right? He's paying us, so that means debtors is decreasing. Debtors is also a asset, so the asset is decreasing here. And also when the debtors is paying us the cash, cash is increasing. Cash is also an asset, so asset increases and asset decreases as well when we collect money from our customers. Transaction number 11. Mr. Suman is paying 8,000 rupees to his supplier. Supplier means those people who is providing us raw materials or the products, or from where we are buying our goods. Okay, so Mr. Suman is paying 8,000 to the supplier, means it is what happens? Our asset is decreasing because he is paying cash to his supplier 8,000. So cash is decreasing. So we have to credit cash. And also what happens? Creditors is also decreasing. Creditors decreasing in the sense, suppliers are those people who we owe money. We are the people who's owing money to them. We might be buying goods from suppliers for credit. So this thing happens when we have already bought goods from a suppliers for credit only. Okay. This is a subsequent transaction that happened if you are buying goods or services from suppliers for credit, or we might be partly paying in cash, partly by credit. So if there is a credit thing element involved, this will be a subsequent transaction that happens. So what it's telling here is paying his 8,000 rupees to his supplier. So what happens? Cash is decreasing as we are paying him, and also he was our creditor. Okay, so he was our creditor. That means we were owing money to him. So when creditor decreases, what happens? Liability is decreasing, means we have to debit it. Okay, then what happens? Transaction 12. He withdrew cash rupees 7,000 for his personal use. That means it is drawings only. So what happens here? He's decreasing money. That means he's taking 7,000 from our business. So cash in the business is decreasing. 7,000 is decreasing, and our capital also decreasing 7,000. So now the business only owes him whatever amount minus 7,000. In the beginning of this discussion, he have invested 5 lakh rupees as capital, right? So let's say he's taking 7,000 from this 5 lakh. Okay. So when 7,000 is taken from this 5 lakh, now the business only owes him 4 lakh 93,000. Okay. So now from now onwards, the capital will be decreasing also. Cash in the business is also decreasing. So when capital decreases, we have to debit. When cash decreases, we have to credit. Okay. That's it. So we have done this discussion because they want to make you remind of certain things. They want to refresh your mind. That's why we discuss these transactions. They are yet to discuss journal entries. They are only talking about the transaction. What are the transactions that involved in here? Okay, so that's it. Now next thing they are talking is about chart of accounts and codification structure. What is it? Let's see. Okay, so now we are going to see what is chart of account is. A chart of account is like a map. Okay, it is like a map that shows all the different accounts in a company's financial records. So it's a list of all the accounts like rent, salaries, bank account, etc. Okay, so with a special number for each one. There is a special number for each of these accounts. Think of it like a filing cabinet with labels on each folder. So you can easily find what you need, right? We all used to have we all have almirah in our home. So, or you can say we have our cabinet where we keep our books and all. We'll be keeping it in an order. Okay, so you can easily find what you need. So chart of account helps organize all the financial information, making it easier to understand and report on the company's financial situation. It's like a blueprint for the company's financial records, showing how everything is connected and where to find each piece of information. This helps investors, shareholders, and others understand the company's financial health and make informed decisions. A well organized chart of account is essential for accurate financial reporting and helps business keep their finances in order. That's all. So that's all about what? Chart of accounts. That's all about chart of accounts. Next, we are going to see codification structure. What is codification structure? We are going to see that. So codification structure is actually talking about how to set up a chart of accounts. We learned what is chart of accounts. A chart of account means what? It is a list that helps organize a company's financial records, and it is like a folder that keeps all financial accounts in order. So that is what we call as chart of accounts. We also provide them with a specific number and all. We already talked about it, right? To set it up, that is what actually we say in codification structure. What accounts the company needs? First of all, we have to decide what accounts the company needs, like cash, rent, sales, etc. We have to first decide what accounts the company needs, and then we have to give each account a unique number, like an ID card number. Like in ID card, there will be different number for different people, right? Each of our other cards have different number. Likewise, for each account, we have to give a unique number, and also we have to give a brief description and name of name for that each account, like a label on a folder, right? So we have to give, first thing we have to do is we have to decide what kind of accounts the company needs, and second thing is we have to give a unique number to these accounts, and the third thing is we have to give brief description, and also we have to name those accounts. Okay, then we have to organize these accounts. So organizing means first thing that comes will be assets like cash, inventory, that comes first. Then liabilities means debts and capital, owners, investment also. Then comes revenue and expenses comes last. Okay, revenue means income and expenses comes last. Most important or liquid accounts come first. That means sales before non-operating income and all. Okay, so that accounts come first. That are most important things. Now we have to design the chart. Start with the main categories. Like main categories means asset, revenue, and after that we'll add detailed descriptions or transactions. Okay, let's say for rent, there will be office rent, other rents as well. So after starting with the main categories, then we'll give the detailed descriptions of the transactions, and this help with future reference and organization. Okay, then think of it like setting up a filing system for your financial records, as we already talked about this example before when we talked about the chart of accounts. Okay, just think about it. You create folders That means here we are creating accounts with labels. We're creating the folders with labels only, right? So that we can identify them, each of them, very easily. It's not needed to take off all of those files and you have to take the pages and understand, okay, this is what actually this folder contains. That will be too time consuming. So what we do is that we'll order everything in a file and we'll stick a label on it, right? So that we can understand, just by a glance we'll understand, okay, this folder contains this kinds of papers, this kinds of information. We'll understand that. So for same like that, we are creating accounts with names and descriptions, organize them in a logical order, and then we'll add details as needed. So this helps us find and manage our financial information easily. That's all. Okay, you see, this is an illustration. You can say just like an example and all. They have given us account codification for a small business organization. See, they have given numbers. You can see here, right? 1000 to 9000. They are specific numbers. So from 1000 to 1999, these include this. Numbers includes what? Asset accounts. The next from 2000 to 2999 includes the liability accounts likewise. Okay, so these are the main categories. These are the names. These are the labels they have given. These are the accounts they are using in the company. Okay, so they have decided what kind of accounts they want, and they have also given a specific number, as you can see. An alternative presentation of typical chart of accounts as follows. So like you see here, these are the balance sheet accounts, because in balance sheet we have asset, liability and owner's equity. So these are included in the balance sheet accounts. And in income statement accounts, you can see operating revenues, expense, overhead, now non-operating revenues, non-operating expenses and losses, etc. These things all comes under what? Income statement accounts only. Then comes what? Very important thing, accounting equation. Accounting equation. What is happening in accounting equation? Let's talk about it. Okay, so our next topic is accounting equation. So accounting equation, to simplify it, to simply explain it, accounting equation shows how a company's assets, liabilities and equity are connected. It's like a math problem that always balance out. Like, see, what is the accounting equation? We have already talked about in one of our concept, I guess. Asset is equal to liabilities plus equity. So assets are the valuable things the company owns, like cash, inventory and buildings. You all know that. Liabilities are the company's debts and obligations to others. Equity is the owner's share, okay, of the company's asset. Then the equation shows that the company's assets are financed by either liabilities or equity. Okay, once again, the equation shows that the company's assets are financed by either liabilities or equity. That means owner's investment. Liabilities means debts. So either this asset will be financed. That means we are buying these assets, or we are purchasing this asset. By how? From where do we get the money? Either by debts. We might be borrowing money in order to buy an asset, or it might be the owner's investment. That means equity. So this asset can be financed from liabilities or equity. So this is what the accounting equation actually talks about. The expanded equation breaks down equity into its components. So we can also break down this simple accounting equation. Right now it feels it is very easy, asset is equal to liabilities plus equity, but we can also break it down. Okay, so the bracket have to be the first thing we have to focus on. So the first bracket we see is revenue minus expense. After doing that, we'll get an amount. That amount have to be added with capital. Then what we have to do? We have to subtract drawings from this amount and then add the resulted amount with liabilities that should be equal to assets. Okay, so this equation is the foundation of double entry accounting, which we'll be talking later, which means that every transaction affects at least two accounts. We have already talked about it, right? We already told that every transaction have to affect at least two accounts and keeps the equation balanced. Only then, if there is only two transaction affect, we can keep the equation balanced. So think of it as like a seesaw to keep everything balanced. So that is when one side goes up, the other side goes down, right? So likewise, we have to keep it balanced. If one side have to go up, other side have to go down. So the equity, we are saying we can break down equity into capital. That equity is been broken down into this. Okay, equity is broken down into this, as you can see. Then we can also, after taking those amounts out of the bracket, we will get the final equation as this. Okay, that means asset plus expenses plus drawings should be equal to liabilities plus capital plus revenue. And using this equation, we are further discussing these transactions. Okay, you can see asset plus expenses plus drawings, this should be equal to this. Okay, so when proprietor is bringing cash, what happens? Cash increases. Cash involves an asset, right? Cash comes under the head asset. So cash increases. Capital increases, right? Here capital comes under capital only. And when goods is purchased for cash, expenses, right? It is expenses. And also cash decreases. So both have to be recorded under this head. There is no impact on liabilities, capital or revenue. Okay. And because when inventory is bought, cash is decreasing. So already it is balanced under this head itself. Okay. And other thing is when goods purchased for credit, what happens? When goods are purchased for credit, creditors increases. So it comes under here. And if you focus deeply into it, you will understand that if there is two transaction under this head, if there is two transaction under this head, that means there will be no transaction here because it is already balanced under this head itself. As you can see, if there is no two transactions involved, like see, this has got two transactions, this has got two transactions, but if there is two transactions, there is no need, there will be no entry in here because it is already balanced here itself. If it is not balanced, there will be a transaction here, there will be something here under this head, so it will be balanced. If it is already balanced here itself, that means if there is two entries here itself, then there will be nothing here. That's it. If you focus deeply, you will understand that. Okay, that's it. And so when we are buying goods for credit, what happens? Creditors increases and our inventory increases. That means our asset increases. When goods are bought for cash, what happens? Our cash decreases. Our inventory decreases as well. Inventory means our stock decreases because we are selling goods from our stock only. Okay, so our stock decreases and our cash increases because when we are selling goods, what happens? We get cash. And if you are going to sell goods for credit, what happens? Our debtors increases. Debtors are assets only. Inventory decreases. Stock decreases. That is also an asset. And salary, when salary is paid, what happens? It is expenses. Okay, expenses comes under this head only. So when salary is paid, expenses increase, and what happens? Cash or bank decreases. When rent is received, what happened? Rent is received means it is a kind of revenue. So cash increases, and rent received is a revenue, right? So as you can see, it is a revenue. It increases. Rent received means revenue increase, and also cash also increases. When goods are withdrawn by proprietor means what? Our stock is decreased and our capital increase. When goods is withdrawn by proprietor, in this sense, it is referred to as drawings. So inventory decreases, our capital also decreases. Why capital decreasing is means the amount which the business owes to the owner is decreasing when the owner takes away money from the business. Okay, that's all. And next we have to talk about is double entry system. Okay, so next we are going to talk about is double entry system. Double entry system is a way of keeping track of financial transactions in two ways. Every transaction has two sides, debit and credit, right? Both sides are recorded in different accounts. The system follows the accounting equation as it is equal to liabilities plus equity. Now there is some rules of debit and credit. Okay, so when does this debit comes? When are the circumstances when debit occurs? When asset is increasing, expense increases, loss increases. Okay, that means increase in asset, expense, loss. Also decrease in liabilities, equity and revenues. These transactions will be what? Debit only. And what are the credit? What all things comes under credit? When increase in liability, equity, revenue, also decrease in asset, expenses and losses. So these are some of the rules of debit and credit. So when asset is increasing, we debit. When asset is decreasing, what we do? We credit. When loss is increasing, we debit. When expense and loss is decreasing, we'll credit. And when liability is increasing, when liability, equity or revenue, when those things increase, what happens? We'll credit. And when those things are decreasing, we'll debit. Okay, so this is very important thing. Only after knowing this very basic thing can you start writing journal entries. Okay, so now when I was learning in my commerce, when in my 11th grade, I was a commerce student. So a teacher taught this thing. After understanding this, after learning this, only can we move forward in our accounting classes. Okay, so you have to keep this thing in your mind. And next thing is, double entry system has got 4 steps. What are those 4 steps? First thing, we have to record transaction in the journal. Okay, that means books of original entry, we have to pass journal entries. Next thing, what we have to do, we have to classify these recorded transactions in the ledger. We have to start to record these transactions in the ledger after passing journal entries. Third thing is, we have to check the accuracy with a trial balance. Fourth thing is, we have to prepare an income statement and balance sheet with the use of this with the help of this trial balance to see the financial results and position. Okay, so think of it as like a mirror reflection, because every transaction has 2 sides, right? And both sides are recorded to keep the accounts balanced. That's all about what double entry system. And in our study mat and all, they are actually talking about 2 rules, golden rules and accounting equation. Okay, they are just mentioning there are 2 methods. One is accounting equation, which we already talked about. That's all. Then next, second last topic we have to talk is about books of original entry and subsidiary books. Let's see what does it talks about. Okay, so books of original entry, it is also called as journals, okay, are the first point of entry for financial transaction in a company's accounting system. We have already discussed in our accounting cycle. The first thing that happened is, after identifying the transaction, the next first thing happens is to record them in the original entry, in the books of original entry. Okay, so they are like the initial reception desk for transactions. Okay, initial reception desk for transactions. When a transaction occurs, it's recorded in the journal with a description, with reference to supporting documents like receipt or invoices in chronological order as they happen, as individual entries called journal entries. Okay, so when transaction occurs, it's recorded in the journal. How do we record in the journal? We use a description, right? And with reference to supporting documents, sometimes there will be receipt or invoices. And next thing is in the chronological order, in the order which they happen, even in which the events happen. The next thing is individual entries will pass, right? That is what we call as what journal entry. These journals are also called day books because they are used to record transactions daily. The information is then summarized and transferred to ledger accounts. Think of it like a receptionist desk. Transactions come in, get recorded in the journal, and then get forwarded to the ledger for further processing. Okay, so that's all about what our original books of entry and subsidiary books. There is nothing much to talk about it in here. And our final topic, posting in ledger and finalization of accounts. After recording transactions in the journal, they are posted to the ledger. As we all know, the final destination for accounting records. At the end of the accounting period, like a year or a quarter, the ledger accounts are balanced and closed, right? There is nominal accounts now. Nominal accounts means income, expenses, gains and losses are closed and transferred to the income statement, which shows the profit or loss for that period. The balances of real and personal accounts like assets, liabilities, and equity are carried forward to the next period and reflected in the balance sheet, which shows the company's financial position at the end of the period. Okay, so what happens? Journal, ledger, income statement, balance sheet. So accounting cycle is like a cycle that repeats itself with each step building on the previous one. Okay, so nominal accounts will be shown in the profit and will be transferred to income statement. So that will be the one that's showing the accurate profit or loss. Then the balances in the real and personal accounts, what happens, like asset, liability, and equity and all, that will be carried forward and that will be reflected in the balance sheet. Okay, so they are just simply explaining it. That's all. Okay, so that's all about this section. 1.4 is over. I hope this is clear to you.